So we are now recording, and it is November 17th, and this is the Edge demo. So starting right off, if you longtime users know I talk about options expirations a lot, and I wanted to do that again because that's core. I say that we want to know what the broad market's doing. That's broad sentiment. You want to know what the context is. What is the cadence in the calendar? Because it will alter outcomes, and then trade divergences, or if you short, convergences, which I don't. I'm not good enough. I'm not smart enough to have that figured out yet. So with options expirations, I just want to point out that this is why is this different from the things that are expiring every day? There are daily options that have become a very popular product in the markets, weeklies, and those are half the volume, if not more now. And so you would say, well, why then would it matter if we look at the monthly schedule? Well, the monthly ones are associated with a much greater degree of collateral. If you are, so a lot of edge users do this, buy or sell volatility. You could buy puts or calls or sell them to keep the premium, as you guys know, and you will likely own the stock. Well, the same would be true for the large participants in the market. So those things the collateral gets squared each month, and so that expirations period isn't just Friday. It's not just tomorrow. Today, did you notice today, for instance, there were the only European style derivative in the US market is the AM dated index options that expire generally on about the middle of the month, the 17th this time around. Usually it's Wednesday, Thursday, Friday. So immediately at noon Eastern time, the market turned positive. Did you see that? And there's that. Now, I don't know what the outcome will be, but that tells us that right up to that point, there were folks who had exposure who were trying to get as much advantage as they could before the things lapsed. And so I say the only European style instruments are a date certain. American derivatives, generally, you can use at any point during the duration of the instrument, whereas the European style, you can only exercise it or let it go on a set date. And that's what happens with these index futures that expired today. Yesterday, VIX expiration. So the core things, how long, if I'm looking at this, how long am I careful? Well, depending on what the broad market is doing, it's right up to Wednesday, Thursday, Friday, Monday, new options trade, Tuesday, counterparties will square the books on the demand for new options and whatever exposure they had for the ones that expired the week before and they settle on Saturday. And so they'll get that square. That means by Wednesday, we will have a good look at, we'll be in clear air out of the turbulence that these things create. So I'm careful through those times. It doesn't mean I don't trade, but nearly all of the very small handful of mistakes I have made, we all make them, have occurred by trading into the expirations period. And so I'm very careful about that. And I will generally consider it that period of time. Wednesday, Thursday, Friday, Monday, Tuesday. Then we're in the clear. Periodically, the options period will be split into 2 weeks. And by the way, you all know you can see this, right? I'll just point this out really quickly if I can. Hold on just 1 second here. I can share my desktop. Okay. Okay, so if you go to Market Structure Edge, and up here in the resources, it'll say expirations calendar. We're revamping some of this, by the way. It's just about done, so that we'll have the whole set of a dozen educational videos, very short. I've reviewed them. There are, we use an advertising firm to manage that stuff, and they're just about finished with it. But this will be here, the expirations calendar, and we've updated it, so we have the 2023 version to put up. But it just hasn't been posted yet. So here's November. See this? And here, 16th, 17th, 18th. And then Monday, Tuesday, maybe we should have that on the calendar, but I don't want to consume all of the days. The calendar. This is designed, by the way, for public companies. So that's why you see all of these things on here. The last 3 days of a month, that's when window dressing occurs. So if you're a public company, we say if you have bad news and from a regulatory standpoint, you have some flexibility on materiality, put it out then, because it'll get washed out with the month-end window dressing, and then the money comes back in the new month. So that's just something to know. But that's the expirations period. And why is it so difficult to know what will happen? Well, because derivatives are a right but not an obligation. So while we can see supply and demand, a portion of that is going to be implied demand, and we don't know exactly what's going to happen with it. There's no good, clear, specific indicator. There is short volume, and that's one of the things I'm going to talk about here in some of the examples, just to point out that you can have a pretty good idea what may happen, but not a perfect one. That's why it can be very dangerous. The last time that I traded something STE through the derivatives period, I lost $3,000 on it. That's a very rare thing, but I don't want to have those kind of things happen. So easy way to avoid it is to be very aware of the context and the fact that the calendar may cause the market to do things that you simply don't expect. So questions, observations on that particular issue before we move on to the next thing? Okay. And let me just check to make sure. Yeah, Steve, fire away.
How does the I know you're talking unpredictability on the price of stocks, but what about the volatility? Does it pretty much remain the same?
Boy, that's a good question. I'll answer it this way. We take an average read, and I don't know if it spikes particularly at that point. I won't say it stands out in our data. That's not what stands out. What does stand out is that the market has a propensity to change directions at expirations. If it's been up, it goes down. If it's been down, it goes up. That has been true every month in 2022 so far. Even in July, when the market continued to go up, the direction signaled that was the probability, and sure enough, it was. And I'm going to show you something, but I would say I don't have a good answer for that, Steve. Whether it's if there's a material difference.
Yeah.
Let's see.
I trade volatility is why I ask. So.
Yes, so do I. That is exactly what I trade. Yeah. And for you new folks, what we're talking about, Steve you may want to add to this, but the way I think about it is volatility is one of the core metrics that we put in the portfolio view. So you have an idea of how much a stock should move and can move and what kind of return you can get. And if you capture that, that's take the game, move on. Juan, let me answer your question. Futures and option expirations change the demand and supply figures showed an edge. Well, they're an input because one of the behaviors that we track, let me just show you this. So if we come over here and we're in a portfolio, I happen to be looking at the momentum items, and you click this little question. One of the behaviors that we track, we call risk management. We say that the market is driven by 4 demographic groups. And we will show up in it too. It's whoever executes our trades. The trouble with retail flow is it's almost wholly consumed by intermediaries. I execute trades periodically at the NYSE or the NASDAQ, but it's pretty rare. So risk management is counterparties to derivatives. We say story is active investment, characteristics is passive money. Trading price is fast trading. That's the Citadels of the world. And then risk management is derivatives. It's an input. So it will contribute to supply and demand. But during expirations, what if it vanishes? This is what happens to companies. Look at Target. Target reported results during options expirations. Shouldn't do that. Companies shouldn't report earnings during expirations because you can lose 15 or 20% of your market's value just like that because that's how much depends on derivatives. If 15% of the implied demand vanishes because the value of the opportunity has been lost, you will lose 15% of your price. And that's what happened to Target. It's not that investors suddenly go, son of a gun, I'm going to, Target is worth 15% less. That's not how rational behavior works. It doesn't do a portfolio manager any good to sell when it's down 15% or to sell it down 15%. It's not what happens, by the way. It is derivatives coupled with machines that trade just during the day. That is responsible. So yes, we include it in demand, but we don't know if it will disappear. That's the trouble. And you look at what the market did here recently, it tells me that there's a heavy dependency on derivatives right now. Here's what I mean. So I want to come back to this portfolio. It's one of the items, but this also is an item I wanted to look at. Here is broad sentiment. So if we look at broad sentiment over a 3-month period, this is where we are currently. We peaked, came down, bottomed, and we're rising again, right into options expirations. Look at the supply side. It has tipped way down. That is a divergence that we like to trade. It's the very thing that we look for in stocks. So you would say, well, that's very positive. Well, it did the same thing back here in August. The supply dropped and demand was rising and the market fell apart. It is not proof positive that the market will do what you think when derivatives are involved, because it's such a large part of the market. Now, yes, we did get this nice little tick up in SPY here, but the market would look at the supply side. Immediately after options expirations, this was right after supply shot up. So clearly, there was not the same demand for leverage as there had been in July at expirations. And how would we know? Well, supply starts to rise dramatically and demand begins to fall. And so we know, that's not good. That could happen again. I'm not saying it's gonna. I don't know every day what's going to happen. We just have a pretty good mathematical idea. The math is good, but we're right at options expirations, and the two can cancel each other out. So that's what we want to be aware of. Okay, I think you had a part B. Futures change the okay. That's right one. Okay, good. Okay. So this is what. Okay, that I did want to point this out. Look at your dashboard. I mean, it's beautiful, right? Look at your supply demand balances everywhere. I have, airlines, cruise ships, not bad, despite the fact that some of those have moved poorly. And again, right during options expirations. But if you look at your supply demand equations, they're pretty good. Communication services, rising, flat, that's good. Consumer discretionary, up, down, those all consumer staples, all of it looks good. Right? You could look at that data and say, well, there are all kinds of opportunities. If I look at these experimental alpha 1 and 2 portfolios, if I feel comfortable, as I've said, we'll share it. 54 components, 34 components. If I go to momentum, there are a bunch of them in it, 21. And I'm going to use that because you all have it, right? So look at this beautiful supply demand divergence among these 21 components. And tech is in there, right? So you look at this and say, well, the market is just tremendous. There is a whole cornucopia of opportunity. As I've said, if the data tell us there are opportunities, we're going to know. And so the data they're rich with opportunities, but the context is options expirations. This is why you have to be really careful. If I look at this group and I eliminate, probably should do this, but I didn't want to change the data on you. I'm going to get rid of the stocks that are heavily short, make sure that it's it's right around 50%, and sort by demand. We could go right down this list and say, well, there's I pointed this one out, Chinese company, I think, isn't it? Performance Food Group, I forget whether it is or not, but that's pretty good. Look at this data here. I mean, you look at supply and demand. If I owned this, I'd be selling it right now because of this uptick in the supply side, even though that is way below trend. That's a huge supply deficit, strong demand. What's the price done? Done exactly what we expect. But once again, at options expirations, the risk doubles that the math may not perform the way it would all the rest of the time. So you have a higher risk. Doesn't mean you can't trade, but you should be aware of that, right? Tech, one of the ones I pointed out, tech resources. Again, beautiful chart. You look at that and say, well, the price was down yesterday, very strong demand, insufficient supply. That stock could very easily move its intraday volatility. Great, but again, right? Options expirations. So they're all kind. I've highlighted some of these, right? GFS, another just beautiful chart. That's what you want to find. Strong demand just hitting 10, supply dropping off. It's not got the Steve Hicks rule quite, which is the last day it tailed off. So, but that's good data. That data under ordinary circumstances would continue to deliver gains, just as it did where the divergence started. As soon as that divergence began, price jumped. It's a very reliable principle. Just beware that during options expirations, I don't mean to repeat myself over and over, but I think repetition is the best form of emphasis, that's occurring. So, okay, that's why I'm very careful. I'm still sitting in cash. I sold my last position Tuesday, and I'm happy to wait. I don't feel I'm going to miss out. So long as what I'm putting to work produces gains, I'm not missing out on anything, right? So now, real quickly, let's look at a few of these earning stocks. If I'm careful because once again, this is when companies report results, there is information and bets that can alter outcomes. Hedge funds bet very heavily directionally on earnings. And so and their bets may be opposite of what the results are. But if their bet is large enough, it will be the determinant. And so one has to be aware of that. So DuPont reported, let's see, November 8th. So here. And so look at 10, it's a 10, and right there, falling supply. What's the probability that stock goes up? Well, it's pretty high, right? There's a pretty good likelihood that stock rises. It's risky for me, but it's a way to look at the data. If it's something you want, this particular user who sent me a note has done a great job. 20 out of 21 positive trades over the last month trading earnings and doing this. Looking at the supply demand balance and say, well, that looks pretty appealing. Home Depot, again, they're reporting right into options expirations. It creates risk. I think they were on the 15th, but look at that. So if they reported here on the 15th, on the 14th, I would look at that and say, well, the supply side's too high, demand's rising, it's back to 5. It's dicey. Is that I'm not sure which direction that's gonna go. And it tells us that the people betting had the same view. And here, probably the bets were incorrect and somebody got squeezed, but you can see that data, right? You would say, well, this stock could probably continue to deliver a couple of more days of gains, but beware of options expirations again. Let's look at a couple more. Lows. Well, they reported on the 16th with VIX expirations, and you already know you have a read, but the data, you look at the data and say, well, this was a straddle again. Demand rising, supply not rising. The price could move, but it's very high. The short volume is 56, 57%. That tells me hedge funds bet both directions, probably slightly short. But it didn't move that way. And did options expirations have that effect? I would say they did. One last one here, Cisco, just reported, I think, today, right? So Cisco, all other things being equal, you could look at this data and say, Cisco flat. It's spent a lot of time. It's a big and stable stock in many ways, but very, demand right at 5, deficit right here. So this tells us people bet long. This is only 40%. So even though it's above the trend, those are very low levels. 42% is below what's in the broad market. Probably those are long bets and an expectation that it performs well. That's still risky to me. But you'd look at that and say, well, the probability is, if those bets are correct, that the price moves favorably. That's how, if you want to do that, this is a core way to sharply improve the outcomes if that's the way that you want to use edge. So I'm passing that on because there are folks who are doing that successfully. Okay. Last thing that I have on my list, and I want to make sure I've got 5 things, but the number 5 is I won't, it's Thanksgiving next Thursday, so there won't be a demo. That's number 5. We'll pick it up again after that. Questions before I get to my last item. Fire away.
Tim, I
Yeah,
have
Barry.
one for you.
Good to see you.
Yeah, good to see you too. Hey, we're getting snow here in Colorado, so I'm sure Steamboat's getting nailed, but
That's good.
But anyways, on options, you say so. Options are implied demand. So why do they affect price if they're implied? Or I don't understand options well enough, I guess. But when they are implied, does that mean a chunk of them, the real shares have to be in some sort of a holding company or something in case they get executed? Or I'm just trying to understand, how do the implied demands affect price?
Because there will be, great question. The answer is there will be an associated proportion of the underlying asset that is tied to that demand or supply. So demand would be, to oversimplify, because there are a lot of, half the market is non-standard options, where a hedge fund might go to Goldman Sachs and say, give me a total return swap. That is a derivative. But it won't be traded on an exchange. So half the options are exchange traded. So implied supply would be puts, implied demand would be calls. And the reason you can't, why wouldn't you just look at put call ratios, right? Wouldn't that be a good indication? Well, it depends on the purpose behind it. The beautiful thing about monthlies is these are heavily used by large institutions, indexes. A 40 Act investment fund can put 10% of its assets into something other than a fully invested position under the rules. And so it's a very easy way to true up tracking. And indexes are enormous now. And so they do that. So then that will affect the way that the supplier of that service, like a Goldman Sachs or a Morgan Stanley or a Citi, hedges its exposure. It will hold assets. It might short assets. When it's a counterparty, it can protect itself. It's not front running a customer order. If Goldman Sachs says, I'll take the other side of your bet, Goldman Sachs is not going to have risk. So that's why it affects the asset class, because there's an associated chunk of assets that are affected. That's what it is.
I gotcha. Thanks.
Yep.
That was interesting.
You bet. Yeah, you bet.
Tim, Gary Morris, a real quick question.
Gary, yes.
When I do a search for security by itself, it doesn't show the volatility like the view that I get in a portfolio view. Is that something that would be possible?
Well, it's something we talked about internally, and the engineers convinced me that the best solution is, so if I'll just go back and put Cisco back in, that is as it is. I agree, because I said, why can't we just do this? And the engineers said, well, it will make it more complicated and it may slow the platform down if we make it possible to see those things without doing exactly what I'm doing here. I just switched the portfolio view and I go search for it in a portfolio. I've asked Nate to improve this a little bit, because I'm not wholly happy with the Boolean search feature here. It picks up too much stuff, but I know it's in text. So yes, this is 2 additional steps to do that, and apologies for that. But it's not because we didn't think about it. We just decided, well, okay, based on taking the best of both worlds, making sure it's fast, responsive, and works well, that we would have to do it this way. That's how you can get very quickly to volatility. I realize it's 3 more steps than maybe what you want. Yeah.
Thank you.
You betcha. Yeah. What else?
Last question, quick.
Okay.
When the market has been falling extremely fast, why does VIX remain stable?
Yeah, well, I'll tell you, it does not make sense. I agree. And I'm not a fan of the VIX as a predictive measure, because it's not predictive. It rises after the damage has already happened. The low volatility is a bigger sign of impending risk than is high volatility to me, because high volatility is a consequence. The VIX is a consequence of things that have already happened. I'm right with you. We have said that over and over. We've said the VIX tells you almost nothing. It only tells you what has already happened. To that point, I find this to be very disturbing. The fact that demand moved opposite of prices. This is broad market sentiment. I should expand it out here. This condition is abnormal. And abnormal conditions are canaries in the coal mine. The same thing happened at March expirations in 2021. And we scratched our heads and said, the heck happened there? Something happened. And what it was is Credit Suisse nearly went bankrupt because it was on the back. It had the other side of those Archegos Capital bets. If you remember, this hedge fund, one of the folks who came out of Tiger Capital, heavily was levered and immensely, had borrowed something north of $20 billion and had something close to $100 billion of market exposure, and the bets failed. And it nearly took Credit Suisse down. So I look at this and say, I wonder who's getting cooked here. And if is it related to the cryptocurrency collapse? I don't know. But whenever unusual behavior happens like this, particularly in the days leading into expirations, I think it points to somebody getting hurt. And you'd say, but the market went up. Yeah, well, that's a squeeze. Somebody lost their collateral, I think. Now we're going to find out. It will sort out. We will find out. But it's a good tag to your comment about the VIX.
I have a quick comment about the VIX. I've been, hi everybody. I've been using it on my charts. I've been trading the Qs, the SPY, and the DIA, and
Okay.
also have the VIX. And what I notice is they, most of the time, work counter to each other. Whereas if the market rises, you have a falling VIX.
Yep.
Then sometimes you have a falling market and a falling VIX. And my take on that was that isn't the volatility, if everybody's in agreement as far as the direction of the market, then you don't really have volatility because you don't have the sort of counter traders. If everybody agrees that it should go down, then it would make sense that the volatility is in fact low and falling because there's nobody's in disagreement, so there's no volatility. Everybody's agreeing that it should go down.
That could be it.
That was just an observation at times when you had some sharp falls and the VIX also falling, meaning that everybody is on the same page.
I can buy that thesis. I think that's pretty good. Appreciate that insight, Alexis. Yeah. Well, guys, I've got to run. I told the crew I could be a couple of minutes late, but that's about all the leeway I've got. So I will see you the other side of Thanksgiving. If I don't talk to you via email, well, certainly you'll be getting Market Desk notes. If you're in the U.S., have a grand Thanksgiving, and if you're abroad, enjoy our day off. We'll catch you the next time. Good to see everybody.
Thank you.
Thanks, Tim.
Thank you.
Thanks, Tim.
You betcha. Thank you.